Hi there, welcome to Relevation Talks. Today it's my pleasure to welcome Conan Lauterpacht, who is the managing partner at Sustainable Future Ventures, SFV. And so the purpose of this session is to basically go quite deep to understand who is Conan, what is his background, what are his lessons learned, what are his views on the trends shaping the future of the built world. So I'll do my best to ask the most tough questions possible and try to be thought-provoking. And so if you like this, go on relevation.org and grab your ticket for Relevation 2022, because that's an event you can't miss. So Conan, welcome to the grill.
Hi, Idris, thank you.
And maybe if there are people that don't know you yet in the audience, why don't we start by giving a bit of background on who you are and what is Sustainable Future Ventures, like all the key terms of the fund, ticket size, stage of maturity, geographies, investment scope. I mean, everything about the fund.
Oh, okay, here goes. Let me start with a little bit about Sustainable Future Ventures, and then I'll talk a bit about my my background. So my name is Conan Lauterpacht. I am the founding partner at Sustainable Future Ventures. Sustainable Future Ventures is a fund launched as part of the Patrizia Group with a focus on investing in technology in the built environment, and specifically technology that helps drive sustainability in the built environment. For us, that means investing throughout the real asset value chain. And so it includes construction technologies, some climate technologies, bits of fintech, bits of insurtech. And from a sustainability standpoint, what it means is that at least half of our investments will be into solutions that address environmental or social sustainability challenges and pass our impact assessment in some way. And then the remainder of the fund can be deployed into general productivity or efficiency, general technology solutions. In terms of our investment stage, we invest late seed to Series B. We primarily position ourselves as a value additive co-investor, and so we're typically writing checks between 750,000 euros at the sort of late seed stage, and perhaps up to 5 million euros if the check is going in at a Series B stage. And as a fund, we have a focus on Europe, but we invest beyond or outside of Europe where we think we can be value additive in helping businesses scale and enter the European market. Ultimately, because we position ourselves as this value additive co-investor with deep connections into the real estate industry or the real asset industry, we think we can be a very attractive investor to US-based or Asian-Pacific-based companies that want to come to Europe and have both European capital and access to European network.
Yeah, network of Patrizia is deep. I'm not sure if they are active outside of Europe, but I remember they're active in many countries in Europe. It's, I think, the largest REIT in Europe. They have something.
So it's the largest independent real asset manager in Europe. It's got about over 52 billion of real assets at the moment, both real estate and some infrastructure. It has operations in Europe and in Asia as well. And we have access not just, I guess, to the Patrizia network, but also to networks of some of our LPs coming into the fund, because it's worth noting that we are a multi-LP fund. So this is not a corporate venture vehicle or anything like this. It's an LP-GP fund with LPs, both from a strategic real estate context and also from a pure financial investor perspective.
Clear.
So that is quite a bit about, I guess, the fund and our focus. I suppose one additional word on the sustainability focus. I mean, why? Well, I mean, for many people that would be obvious. I mean, we believe fundamentally that the drive towards sustainability will lead to the creation of some of the most successful companies of the next 2 decades. But I guess, as this is sort of an interview with a personal element to it, at a personal note, it's important for me because when you think about the life of a fund and the journey of someone as a VC investor, ultimately, when you commit to a fund, you commit to, well, really a 10-year period, if not more in most cases. And as I guess I come into one of the most meaningful decades of my life, it's important to me to feel that I'm doing something productive and meaningful beyond just trying to invest for financial return.
Yeah, makes sense. Which leads to your background, because what I like also is that you were a founder, you were an operator, and so you have seen what it takes to launch business and to generate growth. So can you say a few words about this?
Yes, Sean. And I guess funny, a note at the outset, I guess I think of myself in a traditional technology company basis as an operator rather than a founder, because my primary experience was with Voyanta, where I had the benefit of joining a business that had just been set up a short while earlier. And I guess my true founder experiences have now been actually on the fund side, both with M7 Structure and now with Sustainable Future Ventures. But I certainly think that I had most of the experience during my time with Voyanta, which was a real estate data management platform, and which was my entry into the PropTech ecosystem, really. To go back a little bit earlier, I started out my career working in M&A in London. I realized fairly quickly that wasn't for me, and I was fortunate to have some experience to a couple of interesting early stage companies through that experience. Which put me on a route to looking for an interesting early stage technology business to join. And I was very fortunate to find Voyanta at a point when it was in its very early days. And that was back in 2013 when PropTech, I guess the term, didn't really exist. And certainly so this was just an interesting problem that was trying to be solved in the real estate space for me. And so I've been fortunate to observe the development of PropTech thereafter. But in terms of that experience, I think I probably had some of the more painful experiences, such as having to forego salary whilst the funding round got delayed. And when that funding round finally closed, then effectively using up half the funding round to settle all the debts that you'd been managing before. But also, some of the real positives around actually having a successful exit that was significant and enabled us to carry the business through into its next iteration as part of the Altus Group, which is an international real estate technology and services business. And so after a couple of years having sold the business to them, I then moved into a corporate venture role focused on real estate technology investments and partnerships which could benefit Altus Group, which for those that don't know is the owner of Argus Software, which Argus Software being the primary valuation solution in the commercial real estate industry in use in North America and the UK. And then from there, that gave me a window onto the emergence of some of the interesting PropTech focused funds, both in North America and Europe, where Altus was an LP, and that in turn gave me the idea to try and launch a PropTech investor. And this would have been back, I guess, in 2018, when the European market for PropTech looked unrecognizable to how it now is in terms of the amount of capital there is today and the number of investors there are. But back then, my focus was very much to bring together three key elements to help create what I thought would be, a successful investor in the space. One was technology investment experience, naturally. The second was technology operations experience, which often I find can be lacking in investors, because it's important to understand the challenges firsthand, and also it helps develop a degree of empathy for the founders. And then the third being some sort of clear real estate insight or understanding. And the desire to build that type of investor framed, both iterations that I have of launching a PropTech investment vehicle. The first being M7 Structure, where I had that institutional relationship with M7, and the second now being Sustainable Future Ventures with Patrizio.
Yeah, clear. Wow, thank you. Almost a 15 years a journey. Sum up in a few minutes. Can you, if you go back to your experience as operator, let me ask you maybe a provocative question, but what would be, the biggest mistake you think you've made? Or if we take it in the other way, what is the biggest lessons learned that you remember and that is like really deep in your, like a big lessons learned that you will never make again?
So I'm actually going to take the second part first, and what's one of your biggest lessons learned, and then I'll come back to some of the mistakes we made. And I think for me, one of the biggest lessons is the importance of timing, both in terms of perhaps if you're a founder when you're raising capital, but really more importantly in terms of the product that you bring to market and what you offer your customers. And I guess this ties to some of the experience that we had at Voyanta, which was, I think we were focused initially a little bit too much on what we thought customers should want and not what actually customers wanted. And by that, I mean that we were very focused on selling customers a technology product, which was, a real estate data management solution that had good data cleaning and business rules to enable them to aggregate portfolio level data. And that was really, for the first few years, our focus. What I think we should have been quicker to learn is that many potential customers weren't ready for the technology solution. Actually, what they needed was a solution to their problem, which in reality was some sort of combination of services and technology. Ultimately, they just wanted a solution, and not everyone was ready for one which involved heavy engagement with technology, given the level of adoption and digitization in the industry. And so, focusing on what your customers want at that given time is important. Of course, you need to be looking down the road to understand what your customers will want in the future or need in the future, because if you just speak to your customers about what they want today, you're never really going to be able to innovate. But equally, you need to be very realistic about where customers are on their digitization journey if you're in the B2B space, and try and tailor the product you offer to meet that level of digitization or innovation appetite that they have. And so that is the lesson, is really, focus on what your customers want, not what you think they should want, but connect that is the timing point. Because ultimately, if you're aware that the timing is right for a certain type of product and you push that product, your entry into a market is going to be much easier. And I think, founders need to be particularly careful within the PropTech or real estate tech space in Europe, because the reality is we see very significant differences market to market about what customers are looking for. And so something that has worked, for instance, in Scandinavia, and so has been, which are often fairly early adopters of technology, may well not work in another market, whether that's simply because the market dynamics are different or because the level of digitization is different.
Yeah, regulation, language, culture, industry standards.
Yeah, and of course all those.
Clear. Okay. Thank you very much. And now another question. I recently read an article from the founder of it was an interview from the founder of a multi-billion-dollar tech company in the food tech called Eat Just. And the founder was saying running a business can often be all-consuming, just all-consuming, And so I was thinking of this sentence, and counterintuitively, I think that, in fact, if you succeed in your private life, it can also fuel your professional success, because it gives you optimism, it gives you energy. And so my question is, what are your views on this? I mean, to what extent should you sacrifice your private life to be successful in your professional life? And also, given the fact that VCs are people investors, should VCs be the best friend of founders? Be the people that the founders call when they cry because they had a bad day, they had the bad news, or is this more the role of the psychologist instead of the VCs?
Oh, I think a VC has to be everything to everyone. It depends, but to break your question down into a couple of parts, I think what's my view on the recipe for success in an entrepreneur's personal life. I mean, I think the first thing we always need to remember is that being an entrepreneur is really hard. And for the vast majority of founders, it's a marathon rather than a sprint.
Yeah.
So, you are doing something hard, which is all consuming for many years. And, certainly amongst my close friends who happen to be founders, of whom there are a few, it is a hard line to walk, to be present in your personal life and also to be dedicated and devote the attention that often early stage companies require. And I think the reality is it's a very hard line to walk, which very few people get right. And I think if we think of some of the most successful entrepreneurs in history, many of them have had challenging personal lives because of the strain that being either that type of personality brings, or having to devote that much time to something else, that the pressures that creates on personal relationships. So, you know, but that being said, clearly operating or being an entrepreneur off the back of a firm base is very important. And when, as an investor, I look at entrepreneurs, that comes to the fore. Like that base of which an entrepreneur needs to operate is multifaceted. You know, it's an emotional base, it's your personal or family life, and it's a financial base. You know, all of those things you want to be reasonably solid in order to give the entrepreneur the best chance of success, having regard for the length of the journey that most entrepreneurs' journeys are. And you know, that's why, for instance, I would probably now be fairly slow to back a married founding team. I have done it before. It wasn't successful. Now, that is purely anecdotal, but I think it's very challenging, for instance, in that type of dynamic where you have two people that are 100% emotionally and financially committed to a single enterprise. I mean, of course, there are benefits because they understand the journey, but the reality is, again, going back to just how long the journey can be, I think it can be very tough, either because, you know, there is no release from the stress, or because their financial success as a couple is entirely tied up in one business.
Yeah, clear. Interesting.
I guess, you know, as for, you know, what's the role of a VC, and, you know, should you be part psychologist, part therapist, part investor? I mean, obviously different VCs have different styles and approaches to how they add values to their portfolio companies. I mean, I've got no doubt. I know some entrepreneurs who would say they'd be lucky to get their VC to really pick up the phone for them if something was crucial to the business, let alone if they wanted to have, you know, a chat about how they were feeling in their personal life. And, you know, that is understandable. Like, if you have an investor that has a very large portfolio and multiple funds, you have to be realistic about the level of time that they can actually commit to one company, one founder in that portfolio. But you know, that aside, I think the general job of a VC or any investor is to support the founder. That might be emotionally, but more commonly, I think it's going to be financially or operationally. And of course, it depends on the nature of the relationship, the nature of the founder, the nature of the VC. But again, I think it's important for founders to be realistic in the basis that, from an investor standpoint, that founder is probably one of somewhere between 2 and 25 or 30 founders that those investors deal with. And so it's, you know, they will be lucky if they find 1 or 2 investors that they can really have that very close personal relationship, which makes the discussion of like emotional and other matters realistic. But there are some out there. And that's why I think it's very important when founders think about their investor base, that they build a diverse base who bring different value add. You know, the ex-founder, ex-operator may well be someone who's far more likely to be able to give you that personal support, that empathy, than, let's say, the pure, you know, financial analyst to VC style investor for whom, you know, venture has always just been a financial investment rather than a life journey. But similarly, then you can have one type of investor like that, and then you can have a different type of value add to investor who's got great operational experience or great investor networks or great expertise in a specific sector, such as the built environment, and then you build up your cap table to fill the gaps that you think you have.
Yeah, wise advice. And I think it's also, I guess it's also crucial to take the amount of time needed to build a strong relation with your investors base, because the relation is just starting when they actually invest in the company when they purchase equity. But you need to spend enough time probably to build a relation with them, not only during the board meetings. All right. Great insight. Thank you. Now let's discuss your business approach. So if you engage with interesting founders, you identify great investment opportunity, you're positive about it, you want to start the due diligence. What is your investment process? How do you look at? I mean, what is the the duration? What is the speed of execution? And if you decide to invest, how do you work with founders? And also, I would say, what are your ideal deal terms? Broad questions, like maybe 5 questions throw in a row. But share us a bit your business approach.
Sure. So I guess in terms of sort of assessing the opportunity, you know, the first thing we do is like, we need to have a snapshot on what we think the opportunity presented by this particular business is. So we need to collect that sort of rounded set of data as quickly as we can. And it's why I often encourage like founders to be relatively transparent in the data they share with investors, and particularly with us quickly, because, you know, ultimately we all want to get, ideally, you know, a founder wants you as an investor to get to a yes, but the next best thing after a yes is a quick no.
Yeah.
And, you know, so the more transparent that a founder is with the information they have, and the better structured it is, and the easier it is for us as an investor to analyze it and digest it, the better, because that accelerates the point where we understand what the opportunity is. Then for us as an organization, you know, we are, you know, as a relatively new fund, we're very focused on sort of a collaborative approach or a consensus approach within the fund team. So the next is then really to share the opportunity with us. We're a 2-partner organization, but it's not just about what the partners think, it's also about what all the other investors in the team think about the opportunity. And again, bringing to bear the diverse experience that I've been very focused on building within the team. So that technology, that generalist technology investment experience, that real estate experience, the engineering experience that we also have in the team, so that we have all those perspectives able to fill into the opportunity, assess it, and then really from that discussion, identify what we think the key risks in that business are, and then really focus our diligence on those key risk areas, because that's what's going to move you know, the investment to a yes and to a progress or to a no. And so, you know, that's sort of a high level of how we're going to approach it. Of course, we run a 2-stage sort of gating process. We have an initial investment summary that we review, and if we approve that as an IC, then we push it into the more detailed diligence, and then ultimately that more detailed diligence will result in the preparation of an investment memo. And if we then approve that at IC, then what I might describe as stage 3, which is really that confirmatory legal and other types of confirmatory diligence, begins. And in terms of timing, you know, we are normally a co-investor, and, you know, so that means that for us, the timing is often being driven by the lead investor. Yeah. But, you know, I still say that it's tough to do a deal in less than 2 to 3 months from, you know, from first contact through to the execution of the legal documents. Time and time again, I find founders underestimate or are overly optimistic about how long it's going to take them to get the legals done. You know, I think very experienced founders who are very comfortable with transactions and have done it, you know, several times before, and who are in competitive situations with multiple investors desperate to get around, yes, they can frame the timeline and push things fairly hard. But for the vast majority of founders, that is not the case. And so, you know, really anything less than a month to get just the legal stage done, I think is unlikely to be done. So that sort of takes me to this 2 to 3 month window at best of like what it takes to get a deal done. And I think for us as well, a key factor in how quickly we could move would be how well we know the space that company is operating in. You know, if it's an area we know well, then that level of market diligence and competitive analysis is removed to an extent. And so we can probably progress the deal far more quickly than where you actually need to get comfortable with the broader market as well as the specific solution.
Yeah. Crystal clear.
And I guess I'm just thinking of the last couple of questions you asked. You know, what do you look for and what do you like in deal terms?
Yeah.
I guess if we're talking about a deal, from a founder standpoint, or entrepreneur standpoint, I look for and I like one that understands what's important in the deal terms, makes his case on those points, but is otherwise pragmatic and easy, relatively easy to deal with. Now, not everyone has my attitude on this. I generally believe that most negotiations, particularly negotiations like between an investor and an early stage company, should be relatively straightforward processes. I don't want to see any crazy off-market terms in the deal documentation. And in reality, there are only a few key points that require heavy negotiation. And it's actually quite a red flag for me if I find myself in what feels like the midst of an unnecessarily difficult negotiation, because for me, that tells me something about the founder. It's not only that maybe they're focused on the wrong things, but that if they're difficult to do a deal with me, are they also for difficult to do a deal with a customer?
Exactly. Yeah. No, yeah, completely clear. I'm also maybe curious about the investment team that you are currently looking at. I mean, that you would be excited, like are teams that you're less excited about that you would prefer to avoid?
I mean, let's focus a little bit on the things that are exciting, and I'm going to start really with the areas which within the sustainability area, because that is obviously a focus for us. Areas that we're particularly interested in at the moment would be around sustainable heating and cooling. So that's, that brings in a multitude of potential solutions, but ultimately it's driven by thinking around what are the sustainability challenges for the built environment. They are heating and cooling buildings from a CO2 standpoint, and they are the embodied carbon that exists in the construction stage. And so for us, sort of the first area of focus is that heating and cooling stage, because we think we're more likely to find investable, venture backable companies in that space, perhaps initially, than we are in the embodied carbon space. But that being said, our second area of focus is then looking at sustainable approaches to construction, whether that's modern methods or new materials or other forms of innovation, to try and understand if we think there is something that is both impactful and investable for us. Another area which of focus is beginning to dig into the carbon economy more generally, whether that be reporting, carbon monitoring, or the various types of offsetting plays that are emerging into the space. And of course, that's an interesting area because, for the built environment, there'll be a very significant consumer of those carbon offsets, but there also will be opportunities perhaps on the production side in the future. And it also then overlaps with other industry verticals. So those are sort of three areas that we're particularly focused on, but probably worth noting something that maybe some founders miss is that, we don't just invest in sustainable technologies. We're not a pure clean tech or sustainability tech fund. We invest, throughout the built environment value chain. So, we're also interested in looking at things in the transactions and property management space that we think improve productivity and efficiency. And I guess a brief note on the social sustainability side of things, which can often be overlooked. I think we are currently looking at a number of solutions in the rent to buy or alternative ownership models. We've not seen a successful Divvy Homes play yet in Europe, and that's something that I'd like to see.
Yeah, it's been, I think, since the first time we met, probably in March 2020, if I remember well, just before the beginning of the pandemic in Berlin. I was since then saying, I think the next PropTech unicorn will be in the fragmented ownership, because it's such a huge problem, the affordability, and so I'm super excited to hear that you focus as well and that you're also excited about this. And you touched upon different topics I would like to deep dive in. So you mentioned, this social impact or this social dimension. So we'll get to that after. But first, what is being VC fundable? Because not all the businesses are VC fundable. We could even argue that WeWork was not VC fundable. although they received a lot of amounts from SoftBank, who is also going to speak at Relevation. So we must ask a couple of questions on their perspective there. But so what is for you a fundable VC, a VC fundable business?
Well, I guess the first question to ask is, or answer is, what do you think of as VC? Because the reality is it's going to change depending on the amount of capital that you have as an investor to deploy and the stage at which you're deploying it. So for us, as let's describe, I suppose, as early stage, like that late seed to B stage,
Yeah.
what is investable is going to be a little bit different. But certainly the challenges we see in the built environment space and with things like some of the in the modern methods of construction, things like modular housing and so forth, are things like the capex requirements and the working capital requirements that these businesses have, and which create very serious questions in my mind about how investable they are, at least for early stage venture investors.
Yeah.
If 20% of your invested capital is going to finance the loss-making operation of construction, of running a construction or the development site, it's hard to see how those businesses achieve scale in a manner for which you, as an early stage investor with a limited fund size, are going to be able to partake in without the dilution being so significant at the later stages, that even if you've chosen the right company, you fail to see the level of fund returns that you'd hope to see because of the amount of capital subsequently raised.
Yeah, crystal clear. Now, of course, you're also currently raising capital. So of course, you're ready to deploy capital. You have already different portfolio companies. And this is not an advertisement, of course. I'm not advertising Sustainable Future Ventures to LPs. But I'm curious about what are the key terms of the fund? What makes the fund interesting? What are your USPs compared to other funds? Can you clarify a bit this?
Yeah, sure. So I guess as of we have just an intro note. We have a couple of portfolio companies in. We are investing ahead of our first close because we have capital committed from Patrizia. We are building an LP base as part of that first close, who comprise both strategic LPs, so real estate investors who are investing because they want insight, and pure traditional financial investors who are investing in us because it's just an interesting asset class, an interesting space. And our USP is really sitting as this hybrid between financial venture capital, which is what we are, but strategic capital in the sense of having these deep industry insights, networks and connections through Patrizia, but also through others in our networks, which enable us to bring this built environment value add to companies in a very close way. And of course, there are plenty of funds out there that have strategic LPs in their LP base, but the reality is, even when there's a difference between having an LP in your LP base that's interested in the space and being really able to get insight or value out of that LP in regard to a specific portfolio or potential portfolio company. And then, interestingly, within specifically to Patrizia, we have the benefit of leveraging this technology and innovation group within Patrizia, which is a 14-person team focused on new technologies in the space. So effectively, although we are a new and emerging fund team, we leverage sort of the general institutional network and organization of Patrizia, but also this very specific technology-focused team that help us, see a greater amount of deal flow, help us do additional diligence and gather additional insights. So, again, we think we're just a slightly different positioning with like a very close play to a large global institutional investor and all the support that comes, but married with a professional financial focused venture fund.
Yeah, clear. And I can only confirm the fact that Patrizia is pretty mature in their innovation strategy. I remember the efforts of all the team, the team with Gregory Pittel, Philippe Lefort, and all of them, starting already 5 years ago. So they were really early in the the digital transformation journey, trying to test and learn stuff. And so I think they're pretty mature in their vision for the future, in their innovation, in their vision of innovation. Now, maybe another question related to the the due diligence on founders. So we spoke a bit about it, but so the HR due diligence. I remember I asked to Tanguy Cuero, the EMEA director of JLL Spark, how do we conduct this due diligence on founders, his HR due diligence? So what are the personality traits that he likes or that he dislikes? And so he was saying, according to him, the most important was if the team was able to show resilience in the past, because it can show that they are able to adapt to crisis. They have this determination, obsession, or they're dedicated enough to navigate crisis. And so it was for him like something making him more comfortable, which brings me to the point that I think often resilience is linked to crisis, is linked to suffering, and so I think often founders that went through suffer are able to use this as an energy to be dedicated, to be super motivated. And so my question is almost philosophical question, but is suffering a success criteria for founders? Should they suffer? If they didn't have an harsh life, it means succeeding will be harder, or is this just sadomasochism?
Look, I don't think you have to suffer as a founder. And look, there are some founders out there, very successful founders, who, let's be frank, they came up with an idea and they climbed on a rocket ship, and a company was hugely successful. And of course, everyone has their challenges on the way, but was their suffering very significant on the way to building a significant business? Probably not. Again, they are the outliers. For the majority of entrepreneurs and founders out there, it is a tough journey. As we've already talked about, it's a marathon. And so certainly, to Tanguy's point, resilience is important, but it's certainly not sufficient. There are, when I think about the key qualities I look for, undoubtedly there's an element of the overlap between experience, aptitude, and drive, which are all very important. And then on top of that, the flexibility of mind that allows you to both be driven but also be open to others' perspectives, which is important both as you try and iterate on a product, and also then once you've got product market fit, as you build a successful management team and your role as entrepreneur changes from one of being everything to one of really being a manager of people. And so that's really, I guess, 4 characteristics for me that I sort of overlay on top of that resilience element.
Yeah. Okay. Love it.
But I guess to close it out, though, as I said, I don't think founders have to suffer. And I think that for those investors that do, that's an unfortunate belief. Resilience is important. Suffering is not.
No, of course. It was a wrong way of presenting the question, but I remember I had a co-founder in one of the company I launched 6 years ago, and actually the relation went bad at some point because he was very good at enjoying the fruits of the fruits of our efforts, but not planting the seeds. And so I had the feeling that I was doing 80% of the work, 80% of the value add, and so basically, long story short, it all went to the conclusion that you didn't suffer enough, you didn't put the energy enough, you didn't, and you are not forced to succeed, and so you don't do it. And so it was all a question of drive at the end of the day. So, but you mentioned it, the drive is crucial.
But it's a super interesting point that you raised there, though, and that's this whole sole founder versus multi-founder dynamic, and what does an investor like to back? And traditional rationale would be, let's have some complementary co-founders, because like we've said, it's a really tough journey, and if you have co-founders, they help share the burden of that journey, and you can provide emotional support to each other. But the big if is, provided they do share the burden and contribute in a meaningfully, and the reality is, for many early stage companies, that's a real challenge. I mean, I've seen many cases of an initial co-founder being brought into a business who ultimately turns out not to really deliver on that hope of what a co-founder might bring.
Yeah, of course, of course. Now, maybe the last question, which was related to social impact. So we discussed a bit about it, but I would like to have your views on because we all know the environmental impact of construction and real estate, 42%, etc. We need to reduce by 50% CO2 emissions by 2030. So all of this we know, but what is often forgotten is the link between social impact and real estate, the link between wellness and real estate, maybe the link between mental health and real estate, with all this well certification story. So I would like to have your views on how can PropTech can improve the society, you know, from a social point of view, and what is the link between well-being and real estate and PropTech at the end of the day?
Okay, so I mean, I think there were two key areas in which PropTech real estate can impact on social elements, and the first is the one you mentioned, which is like, how do we improve the quality of life and occupation of the places where people spend all their life, whether that is the home, the office, or retail and leisure venues. And then the second is around, okay, how can we perhaps help individuals gain access to real estate as an asset class, whether that is as a buyer or as a renter? How can technology help reduce some of the barriers to entry, which are very significant given the appreciation we have seen in capital values over the last 20 years, meaning that the vast majority of millennials and Gen Zs are going to be unable to afford to buy their own home. So to go to the, I guess, quality of life or user experience in the first, I mean, we've seen a number of solutions relating to whether that's air quality or the way you engage with your office or your home, and there is a play there undoubtedly, and the reality is landlords are now more focused on that than they've ever been, because as we manage the return to work post-COVID, it's now not an option. If you want your employees to want to come back into the workplace, you have to make it an attractive place to be, and you have to make it something that offers something that being at home doesn't offer. And so I think we will certainly see that. On the social side, which I think in relation to access to the asset class, which I think both you and I are perhaps more excited about from a pure investment standpoint, whether it's removing the barriers as a renter, so alternatives to things like rental deposits, of which we've seen some companies emerge, or perhaps most interestingly, looking at ways in which we can improve access as to ownership, whether that is through increasing innovation around mortgage lending or developing models around renting to own and similar. I think that's a very exciting area where I, like you, believe we can see a large effect over cross business between fintech and PropTech be built, which is exciting for investors and has a meaningful impact on people's ability to buy their first home. Absolutely.
Crystal clear answer, and it was, I think, a tough question. So well done. Thank you for sharing all these thoughts and your insights, and I personally enjoyed a lot. And this is just an appetizer for what is coming, because you will also do the great opening keynote of Relevation 2022, and so I'm super excited about it. So thank you, Conan. And
thank you, Idris. It's been a pleasure as ever to speak with you.
Looking forward to see you soon.